Let me tell you a story today. When I bought my term insurance, my CTC was about 30 lakhs a year. I had a spouse, two children, no dependent parents, home loan EMIs. On paper, everything looked comfortable. But I asked myself one clear question. If my income stops tomorrow, what will my family actually need in rupees term? So I opened Excel. As you can see, I had already told you that my annual expenses per year is 10 lakh rupees. Number of years my family may need support is 15 years. So total living requirement is 1 crore 50 lakhs. My home loan is 80 lakhs. Education cost for the two children, 40 lakhs per year. Total liabilities and goals, 1 crore 20 lakhs. Add 1 crore 50 lakhs for living requirements for 15 years. That comes to 2 crore 70 lakhs. My existing assets, which when I calculate, it comes to 70 lakh rupees. So my required term insurance is 2 crore rupees. Total number, 2 crore became my term insurance cover. Not because an agent suggested it, not because it was 10 or 15 times my income, but because that is what my family would actually need. I also structured the policy till my age 60. My original target for financial independence, the idea was simple. Until my assets can replace my income must be insured. And that Excel sheet changed how I look at insurance. Today, I will show you why term insurance is the foundation of a financial independence plan. Who actually needs it, how much is enough, and when you can finally stop it. Term insurance is not meant to make you rich. Its only job is to protect your family if your income suddenly stops. That is the real purpose of term insurance. Term insurance is pure protection. You pay small premium. If you die during the term, your family gets a large payout. If you survive, there is no maturity value, and that is exactly how it works. Term insurance is meant for one group only, people whose income runs the household. If your absence would cause a financial crisis, you need term insurance. If you are the breadwinner, your future income is your biggest asset. Term insurance converts that future income into immediate financial security for your family. Dependents and children do not need the term insurance. No one depends on their income. Insurance is about income replacement, not emotional protection. Many parents buy policies in their child's name thinking it means protection. In reality, it provides no risk coverage and may create a comfort zone for your child, which may hamper his or her growth. I will create a separate video on this topic. In the meantime, just say no to child's plan. Financial independence means your family's lifestyle does not depend on your active income. Until that day, your income must be insured. That is where term insurance fits. Don't ask how many times my income. Ask what will my family actually need if my income stops tomorrow. Term insurance is about real life responsibilities, not one size fits all formulas. First, your family's daily life, monthly expenses, healthcare, and emergencies must continue without compromise. Second, all liabilities, home loans, EMIs, or business obligations should never become a burden on your family. Third, long-term responsibilities, school, college, and higher education must remain fully funded even in your absence. Decide how many years of income your family would realistically need. Typically, 15 to 20 years gives dependents time to stabilize and assets time to grow. You may hear that term insurance should be 15x or 10x your income. This is a shortcut. It ignores expenses, liabilities, assets, and family structure. Two people with the same income can need very different cover. One may have young children and big loans. Another may be debt-free, same income, different risk. Add future expenses, liabilities, and education cost. Subtract existing assets. The gap is your real term insurance requirement, as I explained at the beginning of the video. Most people mix insurance with investment. When protection and profit are combined, both become weak, high premiums and low returns. Please say no to money back plans. Please understand that term insurance gives you maximum protection at minimum cost. The money you save can be invested separately for growth. This separation builds real wealth and support the financial independence goal effectively. You may reduce or stop term insurance only when your assets replace your income. Many planners suggest 2 to 3 times your financial independence number. Here is why. Technically, 1x your financial independence corpus is enough to retire. You are financially independent on paper. You can adjust spending or rebalance if needed. But insurance is about worst case scenarios. Market downturns, healthcare costs, or conservative investing can make 1x financial independence fragile when you are not there. At 2 to 3 times your financial independence number, your family is not just independent, they are resilient. Even with lower returns or higher inflation, the corpus itself becomes the safety net. So here is the balance view. 1x financial independence number is mathematically sufficient. 2 to 3x financial independence number is risk proof for your family to account for term insurance coverage. Buy insurance for risk, invest for growth. Never confuse the two. Term insurance is for bread earners, not for dependents or children. I structure mine 2 crores till age 60 to protect my income until I achieve financial independence. If your goal is family security with financial freedom, this strategy belongs in your plan. Summary. What you learned from this video. Term insurance is income protection, not an investment. Meant for bread earners. Buy term insurance based on real life responsibilities, not one size fit all formulas. Summary. How to use term insurance? Calculate cover from needs, liabilities, and education. Keep it only until assets replace income. 1x financial independence is sufficient. 2 to 3x financial independence makes your family resilient. This is Chetan Vitlani making complex finance simple and powerful. See you in the next video.